Hi, my name is Brian. Welcome to this journey through space. Today we are going to study the chapter which is Principles of Insurance. In this chapter, we'll explore what the principles of insurance are, why they exist, how they shape real-world contracts, and how they ensure fair treatment between insurers and policyholders. These principles are not just legal requirements, they're the backbone of risk management systems across the globe. Understanding them will help you see how insurance maintains balance between preventing fraud, encouraging honesty, and ensuring economic stability. Course Overview. Before diving into the principles, it's important to understand the context. Insurance operates at the intersection of economics, law, and risk management. As economics students, you'll appreciate that insurance allows individuals and businesses to transfer risk in exchange for a premium, making it a vital tool for economic stability. We'll also see that legal principles ensure this process is fair for both sides. By the end of this chapter, you'll understand why these principles are crucial for avoiding market failures in the insurance sector. The 6 core principles of insurance. There are 6 foundational principles: utmost good faith, insurable interest, indemnity, contribution, subrogation, and proximate cause. These are not arbitrary. They exist because without them, the insurance market could easily collapse due to fraud, moral hazard, or adverse selection. Each principle addresses a specific problem in risk transfer, ensuring contracts are both enforceable and economically efficient. Think of them as the laws of physics in the insurance world. If you break them, the whole system starts to break down. Throughout the lecture, we will explore each principle with real-life examples. Utmost good faith. Utmost good faith means both the insurer and the insured must fully disclose all material facts. Unlike regular contracts where buyer beware applies, insurance depends on honesty because the insurer cannot physically inspect every risk in detail before issuing a policy. If one side hides key facts, whether intentionally or by accident, the trust foundation of the contract crumbles. This principle reduces information asymmetry, allowing insurers to set fair premiums. For example, if you apply for life insurance and fail to disclose a serious medical condition, the insurer could legally void your policy, even if that condition isn't related to the claim. Example: utmost good faith in action. Consider James, who applied for life insurance but didn't mention a recent heart diagnosis. He later died in a car accident, unrelated to his heart condition. When the insurer investigated the claim, they found the omission and voided the contract. Legally, they were correct, because the entire agreement depended on truthful disclosure from the start. Economically, this prevents adverse selection, where high-risk individuals get the same rates as low-risk ones, causing premiums to rise for everyone. Principle of insurable interest. This principle ensures you can only insure something if its loss would cause you a financial detriment. Without it, insurance could become a form of gambling, where people insure things they have no stake in and profit from losses. Insurable interest must be present at the time of the contract for property insurance and at the time of loss for life insurance. For example, you can insure your own house but not your neighbor's. This reduces moral hazard because the insured wants to avoid loss, not benefit from it. Principle of indemnity. The goal here is to put the insured back in the same financial position they were in before the loss. No richer, no poorer. It stops people from deliberately causing damage to profit from insurance. This is mainly applied to property and liability policies, not life insurance. Compensation can come in different forms: cash payments, repairs, replacements, or reinstatement. Limitations like deductibles, market value adjustments, and some insured caps prevent excessive claims and keep premiums sustainable. Principle of contribution. When multiple policies cover the same risk, the contribution principle ensures the insured can't claim full compensation from each insurer. Instead, insurers share the payout proportionally. This prevents unjust enrichment and aligns with the indemnity principle. For instance, if 2 insurers cover a building for the same peril, they split the loss based on agreed formulas like pro rata or maximum liability. This also stops insurers from competing unfairly by refusing claims when multiple policies exist. Principle of subrogation. After paying a claim, the insurer can step into the shoes of the insured and recover the amount from the third party responsible for the loss. This keeps liability with the guilty party and prevents the insured from getting double compensation. For example, if a driver damages your car and your insurer pays for repairs, they can sue the driver to recover costs. This keeps premiums fair because insurers can reclaim some payouts instead of raising everyone's rates. Principle of proximate cause. When multiple events cause a loss, proximate cause identifies the main, dominant cause to decide if the claim is payable. It follows the legal maxim causa proxima non remota spectatur, the immediate, not the remote cause, is considered. This is important when some causes are insured and others excluded. For example, if a storm damages your roof, covered peril, and then rain damages the interior, not specifically covered, the storm is the proximate cause, so the insurer pays. This principle ensures fair and consistent claim decisions. Legal framework and case study. Insurance principles are reinforced by laws and court rulings. A landmark example is Carter v. Boehm, 1766, which established utmost good faith. Carter insured Fort Marlborough without disclosing its vulnerability, and the insurer refused the claim when it fell to the enemy. Lord Mansfield's ruling set a precedent that insurers rely on facts known only to the insured. This shows how legal systems shape economic behavior by enforcing fairness in contracts.